Hello and welcome everybody. Happy Friday. I see lots of friendly and recurring faces in the chat, as well as a few new ones today. So happy Friday, everyone. We've made it to the weekend and we are 1 week away from Thanksgiving. So without any further ado, let's get straight to it and say hello to everyone we have with us today. Hi Nancy, Jorge, Emelida, Adelita, Juan, Eddie, Iris, Kike, Sylvia, Vero, Val, and my mother. Magnolia, Gloria, Jose, Blaze, Alex, Iris, Isabel, Syria, Lily, and Rina, and Veronica. Welcome everyone, thank you all for being here, and I have a very fun topic for you all today, because it's something many of you are familiar with, but many of you may not know everything about them. So today, I want to talk a little bit about dividends. Lots of companies pay them, lots of funds pay them, but let's go into a little bit more detail about why they pay them, why they're a great thing for investors, and where you can find some research to find your next dividend-paying stock or fund. So, without any further ado, today's topic, as I just said, is dividends. So, best place to start is to go over what a dividend actually is. So, a dividend is a portion of a company. Well, not so much a portion of a company like a share, but it's a portion of a company's earnings that they pay out to shareholders. So this may be something that they pay out every month, every quarter, which is every 4 months. Sorry, 3 months. Why do I always do that? Quarters are 3 months. They may pay it out semi-annually or annually. But how much they actually pay out is a number that they decide. So that amount is decided by the company board of directors. So behind every head of a company is the neck, and the neck of the company is the board of directors, and they can turn the head any which way they want. So the board of directors are the ones that actually get to decide how much dividends are and when those dividends are paid out. And then after they give out how much they'll pay and when they're going to pay, they put up this proposition or this proposal to the shareholders. And then the shareholders get to decide if this is how much they want to be paid out and when they want to be paid out. So any shareholders that hold voting rights, so any voting shares, as well as any employees that hold stock in that company, or any executives that hold shares of that company, will all have a say in the amount and the time at which these dividends are paid. And like I said before, we can usually expect when we're going to have these dividends. Most dividends are paid out on what's called a recurring basis or recurring time interval. So just like, a month is 30 or 29 or 28 or 31 days, we can expect these payments to happen at a certain period. So it may be quarterly, which would be every 3 months, maybe semi-annually, which is 6 months, annually, which is yearly, or companies can also pay additional dividends whenever they want. Maybe Tesla had a really good year, so they want to share a little bit of that. They want to give you a little piece of the profits because they made a lot of money. They want to thank you for being part of their company or part of their investors, so they give you a little share of their pie. So that is what dividends are. So now, who actually pays these dividends? Well, the most obvious one and the place that you're going to most commonly see dividends are publicly traded companies. Now, they don't have to pay dividends. Some publicly traded companies will not pay any dividends. A very notable example of this is Amazon. Amazon does not pay regular or recurring dividends, but another company like Apple may, and Apple does pay dividends quarterly. In addition to companies, publicly traded companies, ETFs and mutual funds very likely will pay dividends, where most funds will pay recurring dividends as part of their investment objective. They say, our goal is to follow the technology sector, and we will pay out our dividends quarterly. Now, the reason that many of these companies will pay dividends, or these funds will pay dividends, is that if they hold companies or if they hold equity that has dividends or pays dividends, the funds are required by law to pass these dividends on to their shareholders. So if you're investing in an exchange-traded fund that looks at the, say, technology sector, it's very likely going to be buying and holding Apple. Apple pays dividends quarterly, which means by law, this ETF has to give you those dividends from Apple. So what they'll do is they'll wait 3 months, collect all of the dividends from all of the different companies, and then pass those dividends on to you, the investor. And there's another group that pays dividends that is mentioned separately because they pay dividends slightly different. Real estate investment trusts, or REITs, are funds that invest in buying, managing, and selling real estate. Now, they don't invest particularly in companies. They'll mostly buy and sell properties. But when they make large trades or when they cash out on an investment, they will pass on some of that investment gains to you in the form of dividends. They won't pay regular dividends. They may not pay dividends according to their holdings, but they're going to pay dividends based on their revenue. So now the question is, why? Now, I just talked about why the different ETFs and funds will pay dividends. They have to by law. But why do companies pay dividends? Like I said, Amazon does not pay dividends. There is no law that says if you are publicly traded, you have to pay dividends. And there's no law that says how much you have to pay in dividends. So why? Why do companies give up some of their profits for nothing really in return? Adelita, yes, I'm going to show you where you can find all of the dates and when those dividends will be paid, as well as how much. So stay with me till the end of the presentation. I will show you lots of places to check that out. So again, why do companies pay dividends? Very simple. It's a reward. When you buy a share of a company, you're not just investing in your money. You're not just investing your money for the hope of returns. You're investing in that company. Now, you may invest in a company not because it's the most profitable thing in the world, but because you believe in that company and you want to be part of what they're working on. You may think that Amazon's mission is a great mission, so you buy Amazon not because it's the most profitable company, but because it's a company you believe in. So companies will pay dividends as a reward for your trust or your loyalty in buying shares of their company or being a part of their shareholders, where they may offer a dividend on a one-time basis because they had an incredible year. So because they had a great year, they want to thank you for letting them be profitable. Because when it comes down to it, shares are a piece of a company. And by you buying shares of that company, you're supporting that company. So companies will want to give you, they don't really have loyalty programs. They don't have rewards points. For them, rewards points are dividends. And it's cash or stock. We'll talk about that in a minute. But they want to give you something. Now, there's two different types of dividends. There's qualified and non-qualified dividends. And we'll talk about that in 1 second. But another reason why they pay dividends is that qualified dividends are paid or are taxed rather as capital gains instead of income. So it can be a very tax advantageous thing for investors. So an investor may be more likely to invest in a company that offers dividends rather than a company that doesn't offer dividend at all. And another thing is High dividend payments can be a sign of a healthy or profitable company, where if you see a company is paying dividends regularly and the amount that they're paying is increasing, that's likely a sign that this company is doing very well, that they're growing, ergo they can afford to give you more dividends. So this is a good thing for the companies, but also a bad thing, because just like high dividend payments can be a sign of a very healthy and profitable company, a company that has to scale back and not offer as much dividends or as often of dividends, that may be a sign that the company's not doing so well. They're maybe a little bit under the weather. So dividends really can be a sign of a strong company that's growing. If they're able to give you a little extra on top, a little Christmas bonus, that means they're probably doing all right. If they have to cut back on costs a bit, one of the first things they may cut back on is their dividend payments, which may be a sign to investors that the company is going through a little bit of a rough patch. And again, like I said before, why do some funds pay dividends? Well, they kind of have to. It's by law required. If a fund gets dividends from companies that they hold, they have to give you those dividends based on what percent of that fund you own. But for other funds that invest in other things, it's optional. So some funds that hold interest-bearing equities, so equities that aren't companies, they may offer interest. So just like your bank will offer you interest on your money in your savings account, bonds, which is essentially a certificate for profit, or a certificate for money, will offer interest rates, where they say we will pay you 5% of this amount annually. So if it's a $100 bond with a 5% annual payout, they will pay you 5% of that amount, or $5, every year. And then at the end of that period, they'll pay you the $100 that bond was worth. So when you get those little $5 payments, if you're investing in a fund that trades bonds, the mutual fund or that fund is likely going to give you that $5 interest payment in the form of a dividend. So now let's go back to this word I said before, qualified dividends. What are qualified dividends? And if we're talking about qualified dividends, what's a not qualified dividend or a non-qualified dividend? So, what they are. A qualified dividend is a dividend that is a reward. It's loyalty points, or however you want to call it, for holding a stock for a certain period of time. A little bit more on what a certain period of time means later on in this presentation. But most of these dividend payouts are from companies or funds, and these are considered qualified. These are dividends that are expected, and because they are expected and they are given at a recurring interval, they are taxed in what's called capital gains. So capital gains is different than income, and because of that is taxed differently, where you can have up to $40,000 of standard income before you even get charged a penny in taxes for capital gains. So it's more tax advantageous for dividends to be considered or fall under qualified dividends, because you don't get taxed on it until later. And when you get taxed on it, it's taxed at a different and lower rate than your actual income would be. Now, we said what a qualified dividend is. A non-qualified dividend is slightly different. These are the dividends that you get from things like stock options, real estate investment trusts, or non-recurring dividends. So your one-time kind of Christmas bonus or the kind of performance bonus dividend. These are not qualified dividends. So as a result, these are taxed as income. So if you were to receive $1,000 in non-qualified dividends, you would be taxed and it would be a part of your income. So if you had $40,000 in yearly income and $1,000 in non-qualified dividends, you now have $41,000 in income. If it was $1,000 in qualified dividends, then you would have $40,000 in income, $1,000 in capital gains. And again, capital gains are taxed differently and more advantageously for you than income is. So it is important that it is taxed differently. Some places will say they're not taxed at all. That's not really true. So be careful. Now, how are dividends paid out? Are they just surprise, everyone now gets their dividend? No. Companies have a timeline or follow a couple of steps and key dates to decide what the dividends are and when they're paid out. So, let's talk about this. Let's talk about our dividend payout timeline. And below, don't worry about that picture. I'll talk about it in 1 second. So the first thing that we have is the announcement date. This is the day that the company says, hey, shareholders, we want to give you a dividend of 3% on, let's say, November 25th. So on announcement date, the company will come out and say, we want to give you a 3% dividend on November 25th. So that is their announcement. And they then give that announcement or that suggestion to the shareholders, and the shareholders vote on it. They say, okay, we like that. Or, no, that's not enough. Or, oh, that's a little bit too much. So they'll decide what the correct amount is and the correct date is. But they don't just say the date. They try and decide what the ex-dividend rate is. Or sorry, ex-dividend date is. And what that is it's the last trading day that shares can be bought and still qualify for that dividend. So, for example, if our dividend was on November 25th, you may not actually, if you buy the share on November 25th, you're probably not going to be given a dividend. They want to reward loyalty, so they want you to buy and hold for a little bit. So the ex-dividend rate is the last day that you can buy a share of that company and get paid that dividend. And then usually 1 to 2 days after the ex-dividend date, which you can see in the picture below, is the record date. This is the cutoff. If you buy a company on this day or later, you missed out, buddy. The alarm went off, or the class bell went off, the doors are locked, and you're not getting in. So that is what the record date is. If you buy on the date of record or later, you missed the ship, bud. So you want to make sure that you buy the ex-dividend date. Otherwise, no dividend for you. Kike is asking, what is the difference between buying drips like Computershare or GiveAshare and other brokerage companies like TD Ameritrade or Fidelity? So that is going to be a difference in the long run because it's going to be a difference in how they are kind of classed. Where if you're buying it for a long-term investment or in a long-term portfolio, you're not going to be taking out those you're not cashing out on those dividends. Instead, those dividends are going right back into your investments. So you're going to be taxed differently because you're taxed on when you take them out as capital gains or as income. I'm sure that we can describe that in a little bit more detail later, or if we can't get to it today, I'm sure my mom can touch on that in the webinar on Tuesday. But really, if you're investing in drips as a normal investment, you're looking not just at the dividend payouts, but how that stock is actually doing. Because you're oftentimes going to make as much, if not more money off of the price of that stock from when you buy it and from when you sell it, than buying it for the purpose of the dividends. And again, there's a lot that goes into how they pay dividends, when they pay dividends, and their history of paying dividends that will decide if it's a company that is worth buying as a drip or if the dividends are just the cherry and the icing on top. So the last thing that we have is after the record date, which is the ex-dividend date is the last day. That is your last opportunity to buy in. If you don't buy there, you miss the boat. Record day is that, well, the ship already sailed day. And then the payment date is when you actually get that money. Now, we've talked a little bit about how you get paid out, and you usually get paid out in cash. But like we've said before, you can also have the option of reinvesting that money back into the company in what's called a dividend reinvestment program. More on that to come. So how do dividends affect the cost? Because remember that this is not money that's coming out of thin air. A company is taking some of their money, some of their hard-earned cash, and giving it to you as a thank you. So how does that affect the profitability, or how does that affect the price of the share of a stock? Well, again, dividends are typically paid in cash, which means that there is money that the company is giving out. They're not just cashing it in for shares, for example, or something that doesn't actually cost them anything. Dividends do cost them money. So because of that, while some companies or dividends can be paid out in additional stock, usually these dividends are paid out, but not from their share price. So company dividends do not usually have an effect on the stock's actual traded price, because the stock's traded price is based on the value of the company, not on the amount of cash that they hold. So when they get paid out, while it doesn't have a direct change of the price, it does have an effect on how we look back at the price. And we'll talk about that more in a little bit here. That'll be a little bit clearer when we talk about the difference between close price and adjusted close. But for right now, let's say this, and again, there are always exceptions, but for the most part, a company's dividends do not have any direct effect on the price of a company, or rather the stock price of that company. Now, dividends that are paid from mutual funds are slightly different, because for them, a mutual fund, as we talked about in Wednesday's webinar, is decided by their net asset value. So it is how much money is their portfolio worth. And because they pay out dividends from the net asset value, that is cash. So their net asset value is the amount of cash, or the amount of value that their assets have. So when they pay dividends, those dividends come out of their net asset value. And as a result, you will end up seeing that the net asset value of that mutual fund will go down when dividends are paid out. So unlike companies, they will pay out from cash, but with the option of reinvesting it. But this is all from cash, not from the actual value of the company. However, dividends from a mutual fund are pulled from the value of that mutual fund, and as a result will have an effect on the actual share price that you find. Now, let's talk about this a little bit more, because dividend payouts do have a significant effect on what we call the historical price of a stock or a fund. Now, this is to say that think about it like this. 50 years ago, you could go down to a store and buy a burger. 50 years ago, a burger would cost you probably about 5 to 10 cents. 5 to 10 cents nowadays won't even buy you a gumball. A gumball will probably cost you a quarter. So because of this, the price of, or rather what 5 cents meant, or the value of 5 cents, is different from 50 years ago to what it is today. Similarly, because dividends are paid out a certain amount every time, while they don't have an effect on the price of a company, they do have a result, when it comes to looking at the value of that stock over time. Because again, you are getting cash. You are getting additional value from your investment, and that value is worth something. So when we're looking at a stock, we see two close prices are given. We have the actual close price, which is what I like to call the time machine price. If I hopped in a time machine and went back to, let's say, April of this year when dividends were being paid out, or rather March when dividends were being paid out, I would see that the stock's price was, say, $100. But then they paid a dividend. After they paid a dividend, we end up having an adjusted close price. And the adjusted close price is based on the close price, hence the name, close adjusted. But it's adjusted for dividend payouts because, again, those dividend payouts, while they don't increase the price of the stock, they do increase the value of your portfolio for that stock. But it's not just dividends that go into this adjusted close price. We also see additional stock offerings. So if a company decides to release more shares, or if a company has an uneven stock split or a buyout, we'll see the change in value reflected in the adjusted close. So again, close price is our time machine. If I went back to that day and looked at the ticker tape for what that stock was trading at, the close price is what I would see. The adjusted close price is the more accurate one if you're looking back in time because it takes into account the value that was created by dividends, stock offerings, and stock splits. And again, I will go through an example of this with you all so you can see exactly what I mean by the effect that dividends have on not so much the stock price, but on the value of that stock. Now, dividends sound great. I like free money. Don't you like free money? So how do we get our free money? Well, it's actually a lot easier than you think. Most publicly traded companies do offer dividends. So any company, well, not any company, most companies that you buy will offer you dividends, and you don't need to sign up for it. You don't need to register for it. It's just something that they'll give you as a nice little bonus every now and again. In addition, many mutual funds, including the exchange-traded funds that we look at here at Sectors Made Simple, the State Street Advisory Group, all of their mutual funds, my apologies, not mutual funds, all of their index funds do offer dividends because by buying a big basket of companies, it's likely that one or two of them or most of them will offer dividends, and by law, their dividends are actually your dividends. So they will pass on those dividends to you as being part of their group. And just like companies, these funds will have their announcement dates, their ex-dividend rates, and all of the above. So you can still expect to see the same kind of timeline for you need to buy before this point, otherwise the ship has sailed if you want your dividends. If you buy before that, congrats, you get your dividend payout. And now, again, dividend payouts can be taken in two ways. Dividend payouts can be taken as cash, or they can be reinvested into the company in what's called a dividend reinvestment program, or a DRIP. Now, this is something that my mom has talked lots about, so I hope many of you already know about what a DRIP is. But we'll talk about that in a little bit more detail for those that may want a little bit more info or have never heard of DRIPs. But when it comes down to this, by the way, you all know I can see chat, right? I'm here. So, all right. But when it comes to dividends, do your research. Because again, many big companies, just because a company is big doesn't mean they like giving you the little bonus. Some companies like Amazon don't offer dividends at all, but Amazon is one of the largest companies in the United States and is one of the largest publicly traded companies in the United States, but they don't offer dividends. So do your research to make sure you find out what companies pay out dividends and what their history of dividends are. And that is the most important thing, is their history. To make this easier, investors have come up with a list. Well, not so much a list, they call it a hierarchy. Or the dividend aristocrats. This is where I put on my little crown and I become a dividend aristocrat. Now, dividend aristocrats are companies in specifically the S&P 500 that have a history of consistent, which means they don't miss their deadlines. They continue to pay out dividends, maybe be it quarterly, semi-annually, whatever it is. They are reliable, so you know you're always going to get your dividend payment. And the amount that they give increases. So they have a history of paying their dividends and giving you a little bit more every time. But to go into a little bit more detail about what it takes to become an aristocrat, these companies must have the following. They must be a company in the S&P 500, which means there can only be 500 of them, or maybe 505, depending on if you count voting and non-voting shares. They must increase their per share dividend, which means it's adjusted for the number of shares. So the amount, if you owned one share, you should get more dividends every single year for at least 25 years. They must have a market capitalization or a value that can be traded of at least $3 billion, so mid-cap or above. Remember, mid-cap is anything from $2 billion to $10 billion. So any dividend aristocrat will automatically be a mid-cap or larger. And they must have at least $5 million in daily trade value averaged over the last 3 months. So all of this is just a bunch of fancy terminology for their good, big companies with a history. We know that their history is solid, and we know that we can expect to see increased and sustained or consistent growth over the next couple of years. Now, who are they? Who are the dividend aristocrats? I would love to be able to give you a list right here on this sheet, but it would be about as long, if not longer, than the mutual fund fees that we talked about earlier. But there's 66 of them. Right now, as of July, well, not right now, as of July 2020, there was 66 dividend aristocrats in the S&P 500. Within this group of the aristocrats, there's what is called the dividend kings. The dividend kings are the elite. They are the creme de la creme, the best out there. Not because they pay the most dividends. We're not talking about amount here. We're talking only about history, a consistent history of payments. Now, these dividend kings will have a history of at least 50 years of increasing dividend payments. So, literally double how old I am, they have been paying out dividends. And not just that, through good markets and bad markets, through the dot-com bubble of 2000 to the recession of 2008 to the COVID crunch of 2020, they consistently have paid their dividends, and the amount that they've paid has gone up every single time. In this list, remember, these are companies that are dividend aristocrats. So a company will be a dividend king and an aristocrat. It won't be a king but not an aristocrat. So these 29 are still in this list of 66, but there's currently 29 of them. So 29 companies have offered dividend payments of increasing amount for 50 years or more. At the end of this presentation, I will show you where you can find this list, but I want to highlight a couple of notable ones, or I want to show you some of the biggest ones. 3M, Coca-Cola, Colgate, Dover, Emerson, Genuine Parts, Johnson & Johnson, and Procter & Gamble all are tied for the longest record of dividend payouts, where for 57 years they have paid out consistent, increasing dividends every quarter, semi-annually, or annually. So this is the royalty upon royalty. It's the kings of the kings. But again, this is a list of 8 companies that have given dividends for 57 years. But there's 29 that have given dividends for at least 50. So there's a lot of great options out there to get involved in investing or buying companies for the purposes of dividends. So where do we actually find all this information? I will give you my list of places. However, I'm sure that my mom has her list as well. So I encourage, if you have any ideas or additional resources, Mom, throw them in the chat, and I would love to highlight them on this webinar or in a future webinar. But I'm going to show you my list. The first and best place to start is Motley Fool's Dividend Aristocrat list. This is updated very frequently and keeps track of all of the aristocrats that we actually have in the market. Finance Yahoo is a great resource for finding the close and adjusted close prices, as well as the dividends. So we're going to go there in a moment, and I will be able to show you how dividend payouts affect the close price versus the adjusted close. Remember, close price is our time machine. If we went back in time, it's the price that that stock was being traded at. Adjusted close counts the value that the dividends created for that stock. Then the NASDAQ website is a great resource. NASDAQ lists dividends for the companies within its exchange. So if it's a company that is bought and sold on the NASDAQ exchange, you can find it listed in the NASDAQ's website. Go figure. Whether it offers dividends or if it doesn't offer dividends. You'll be able to find all that information out on their website. Dividendinvestor.com is a great resource for comparing dividends. Say that you are looking for what dividend yielding company you want to invest in for the purpose of your DRIP portfolio. It is a great resource because it lets you see on one page the history of dividend payments, but not just if they're paying dividends and if their dividend values are increasing, but what's the actual amount? Like how much are you actually getting? So dividendinvestor.com is a great resource to see that, and we'll take a look at that in a moment as well. And then the last one is for just general information about dividends. If there's any piece of information you'd want, dividendchannel.com likely has it. This is the best website I've found in order to find general data and information on dividend payouts and the payment dates for those payouts. So that is my whole spiel. If anyone has any questions, right now would be a great time to ask. If there's no questions, then we'll hop straight into going through the Dividend Aristocrat list and going through all of these different things that we see. Does anybody have any questions? All right, if there are no questions, let's go straight over to here. So the best place to start is let's go look at the Dividend Aristocrats. So we're going to go to Motley Fool, which is fool.com. Spelling is difficult. All right, here's our list. So Again, this is the list of the 66 companies that have all yielded increasing and recurring dividends for the past however many years it's been. So what we actually have here is we have how many years, what sector it's in, and the company and ticker symbol, as well as the exchange. So let's scroll down a little bit. Here we see companies that have 57 years. These are the ones that I listed out before. But there's also others. We see the duration, so how long they've paid out their dividends. Again, we don't know what they pay out, but we know that they do pay out increasing and consistent amounts. And this list is every company that has paid out for at least 25 years. So this is a really great resource if you want an entire list of everything there is when it comes to dividends that are consistent and recurring. So if you're ever confused or you want a place to start, this is not a bad place for that. Then this is one thing. Dividends, Romulo is asking, are dividends for long-term investing? They are a great option for long-term investing because you're not buying in for a company because it's a company that you think the price is going to go up. It's going to be a company that you're looking for that long-term growth. You're looking for that dividend to be a little bit of interest goes a long way over a longer period of time. So you want that little bit of extra money that's reinvested into that company over time. So you get more dividends, which then turns into more shares, which then turns into more dividends, which then turns into more shares. So they're a great option for longer term investments like a 401k or like a Roth IRA, retirement account, whatever it might be. But you can also buy them for a short term where you'll take out the dividends as cash and you'll be charged capital gains taxes based on those dividends. Give me one moment. What's this? Adelita is asking, I've been tempted to take out La Nata of my stock when the price increases and put it aside and then buy more stock. Does that sound crazy? No, that doesn't sound crazy at all. But put it aside and then buy one more stock. If you are buying a stock, so keep in mind that if you own $10,000 of, let's say, Tesla, if you sacar un poco de nata, if you take a little bit out, so maybe take off and sell 1,000, so you still have $9,000 worth. If you bought $1,000 worth of Tesla, you're not really getting anything from the deal. But taking out a bit of profit and investing it elsewhere, by all means, that's a great strategy because it allows you to make your money somewhere and then take some of those profits and invest those profits into a new company. Or you can even invest it into a different type of investment. Maybe you've made $10,000 in stocks, take out a little bit, look at bonds, or look at commodities, or look at dividend reinvestment programs. So, where does that leave us? I apologize. You can't say. I apologize for that. All right, so the next thing I want to show you is the difference between close price and adjusted close. So for this, we're going to go to Finance Yahoo. And let's look up a company that pays dividends, Apple. Apple pays dividends. So if we go here to historical data, here we have our close. So open is the price it opened the day at. High is the highest price it got to. in that day. Low is the lowest price it got to in that day, and close is the last traded price for that day. Now, again, here let's compare close to adjusted close. No difference, no difference, no difference, no difference, no difference. Dividend! Hold the presses. All right, now here's where things change. So here we see that they paid a dividend of 20 cents and half a cent per share of dividend payouts. So what does that mean? Well, now we see that this is 20 cents less than this. This is 20 cents less than this. This is 20 cents less than this, so on and so forth. So now we see that it's adjusted for that 20-cent dividend. We can go back and back and back. 20 cents, 20 cents, 20 cents, 20 cents, 20 cents. It will change slightly. Stock split. Now our dividends change even. Now our difference between our close, which is the left, and our adjusted close, which is the right, has changed again. Go back, go back, go back. More dividends! Now it changes even more. Now we've gone from 20 cents difference to 40 cents difference. And we see that that 40 cents continues. It changes just a bit depending on the actual value, but it's about 20 cents. Or sorry, 40 cents, my apologies. And we see as we go back in time, that difference will continue to grow and grow and grow. So it's very important to think about dividends when you're looking at the close price, because the close price doesn't take into account dividends. Adjusted close price will. Again, for your everyday investments, this is not something that will make a huge difference, but if you're doing anything like back testing, which is testing a strategy over old data to see how it would have done, this will matter. So it's worth talking about. Now let's go to NASDAQ.com and let's look up Apple. And here we should be able to find their dividend information. Here we see their dividend pay rate. So, hey, they paid dividends on my birthday. That's great. I don't own Apple, but I would have gotten some birthday money. That would have been nice. But here we see the dividend pay date was November 12th. Great day. And we see the ex-dividend rate. Remember, we talked about this. The ex-dividend rate is the day that if you buy on this day or before, great, you get your dividends. If you bought on November 7th, so sorry, no dividends for you. So if you bought on November 10th, sorry, no dividends for you. And how much dividend did they pay? They paid 0.69%. So that is where we find some basic information about things like dividends for companies in the NASDAQ. Now, I want to show you one other thing, which is the dividend calendar. So on NASDAQ's website, you can find the dividend calendar, which is upcoming dates for different companies within the NASDAQ. So what we have here now is a list of when dividends were announced, when they're coming out, and who's paying out what when. So on the far right here, we have the dividend announcement date. This was the day that they announced what their dividends are, how much they would be, and when the cutoff date is, and when the payment date is. So here we see the announcement date for Adams Diversified Equity Fund. They announced it on my birthday. They are cutting off on the 20th. If you bought on the 23rd or later, too bad, so sad. When are these dividends actually being paid? They're being paid on December 23rd of 2020. Alex is asking, I understand that dividends are included in DRIPs and that you and Julia mentioned that these are for long term, but can we change from one company to another in a regular basis based on the comparison of companies' performance? And if we can, how often can we do it? So if you're buying in a portfolio that is meant for long-term investing, they will probably have a limit to how long or how often you can buy and sell. It's not meant for day trading, it's meant for long-term kind of benefit. So it doesn't matter how often if you're buying and selling in a normal portfolio, but what will matter is when you sell that share and buy a new share. It doesn't matter if you're buying for the purpose of a DRIP or not. You will be charged capital gains taxes based on, well, capital gains. So when you sell a company, you are charged or you are taxed based on the profits or the capital gains that you've gained from that company. Doesn't matter if you reinvested it in another company, the fact that you took money out and then invested elsewhere means that you're being taxed for that capital gains. So it's not so much a matter of can you? Yes, you can, but you're going to be taxed when you make that trade. Not when you buy it, when you sell it, you will be taxed. Lily is asking, ¿tiene sentido comprar DRIPs cuando se tiene mutual funds que también tienen estos stocks? Sí, hay mutual funds que están invirtiendo solamente en compañías que tienen programas de DRIP. Hay mutual funds como DRIPX que están invirtiendo solamente en estas compañías. Pero hay muchos mutual funds que están invirtiendo en muchas compañías y estas compañías van a darte dividends y estos mutual funds con los leyes necesitan darte estos dividends, pero si estás pagándote el DRIPs, los dividends no van a invertir el dinero del dividends en más compañías o más inversiones, solamente van a darte dinero como el DRIP, como el dividend. Was there another question? No. All right. So, again, on NASDAQ, we can get a very great readout of when dividends are announced, when the cutoff for that is, and when those dividends will be paid out. Milena is asking how we have to pay taxes. We paid taxes if we leave the money in the account. When I buy again, I have to pay taxes from the same money. That is a great question. It's not so much that you pay dividends or you don't pay taxes on the money in the account if it's in a long-term account. So if it's in an account for a Roth IRA or something like that, you're taxed in terms of long-term capital gains, not short-term. So long-term is going to be taxed differently, if at all, based on the amount that you have in that account. But short-term capital gains are going to be taxed on a basis very similar to your income, but slightly delayed. So again, up to about $40,000 of income, you don't pay any capital gains taxes. After that, you will start to pay capital gains taxes. So if you are investing in an account that is your normal TD Ameritrade, you're going to be paying those capital gains taxes yearly. If you're investing in a long-term account that will have restrictions on how often you can trade or how often you can take money out, those will be taxed better and more advantageously because they're meant for putting money aside for retirement or for whatever long-term benefit you have. All right, so I also want to show you guys this last tool, which is dividendinvestor.com. Dividend Investor will allow us to believe it's under screeners and directories. Nope. Let's see if I can find where it is. Scorecard? Yay, scorecard. All right. So what we see here is, actually, no, this isn't it. Here we go. Dividend history is what we had to find. So dividend history right up here. We can list companies. It's very small, so let me make it bigger. So we list companies here. So Johnson & Johnson, Apple, let's add Tesla. Tesla doesn't pay any dividends. So you can see here the amount that it pays. This is a percentage that it pays, and how much that's actually worth, to give you an idea of when they're paying dividends and how much they're paying. So here you can see a comparison between Apple and Johnson & Johnson, where you can see Johnson & Johnson pays, on average, higher dividends than Apple does. How much? Well, Johnson & Johnson is paying 2.75% right now. Apple is paying 0.69%. We saw that earlier. So this is a great way of comparing different companies on one page to see how much dividends they're paying and when. And then on the far right, it should tell us, yep, the dividend growth over time, be it 3 years, 5 years, 10 years, and 20 years. So again, there's a lot of resources out there for dividends, and I'm sure that my mom will have a few more that she can recommend, but this is what I wanted to go through today. What dividends are, where this magic money is coming from, how you can spend your dividends, whether you want to claim it as cash, aka capital gains, or if you want to reinvest it into the company in drips. And all of these are, is there any way to save taxes besides the long-term investing account? There's a difference between dividends that are taxed as capital gains versus income, but besides that, not really. You're kind of going to have to be paying taxes on this revenue. Maybe that's a class that I can do for the members. I can probably do a class on taxation for different types of investments, but that's definitely not a conversation for today. And then the last website I want to show you before we end today is dividendchannel.com. It's super old looking, but it gets you the information you need. The reason I really like this website is they give you a graph. So you can see a graph of the dividends that they've paid out over time. So you can see that they have a history of increasing dividends, when they increased them and how much. Over on the right side, you can see when and how much, as well as a price chart, because, you know, if you're not buying a company solely because it pays dividends, knowing the price of it is important as well. So again, lots of resources are out there because dividends are a great opportunity for investors. It's kind of like our rewards program for different companies. Companies reward investors for being a part of their group. You can't just jump on board because they're paying a dividend. They do have some restrictions for that in the form of their cutoff days. But for the most part, this is a great opportunity for investors because it is essentially rewards points for being an investor. There are companies like the Dividend Aristocrats that have a long history of paying sustained, consistent, and increasing dividends. And there are many companies that have paid dividends of 50 years or more, aka the Dividend Kings. You can find a full list on NASDAQ.com's dividend calendar. Is this going to work? Nope, of course not. Regardless, you can Google it. NASDAQ dividend calendar to get the list of when companies are releasing their dividends and when the cutoff dates for those are, if you're interested in just buying companies for dividends. Otherwise, dividends are a great opportunity for both short-term investment and long-term savings, because it's essentially being able to take a little bit of cash and reinvest it straight into that company, done automatically. Thank you all so much for joining us today. I hope everyone has learned a little bit more about dividends, because again, it's a topic many of us knew a little bit about, but it's nice to know the whole story. So now you all know the whole story about how dividends making your profit and reinvesting your profits into a company simple and easy. Thank you all for joining us today. Remember, Sectors Made Simple members, we'll be having our members class next Monday instead of Wednesday, as well as the Inversores and Sectores class on Tuesday, and we will not be having a free webinar next Friday in honor of Thanksgiving. So for everyone, have a great Thanksgiving, safe holidays, and safe travels if you are going to visit family. For all the members, we'll see you on Monday. And from Sectors Made Simple, thank you so much for joining us today. Have a great weekend, and we'll see you all very soon. Thanks, everyone.